So this video is a continuation of our Chapter 6 Example 3 question. We are going to now start with Step 4 and figuring out the income statement side of our non-controlling interest. So the first line we want to start with is our sub's net income. We can find this information from the question right here. So 63,000. You can also find it from above. Either way, same number. So let's input that. Now remember, we want to start it off as a negative because we're trying to represent or reflect that negatives are credits. And next item is our acquisition differential amortization. We only want to capture the current year, so we get to hop all the way back up, and here it is, 4,400. Now, the profit in the beginning inventory and ending inventory is only going to be focused on our upstream transactions, because remember, the non-controlling interest doesn't apply to the downstream ones. So our profit in beginning, we can pull it from right here, which is going to be a negative of 6,600. And our profit in our ending is going to be from right there, and it will be a positive 12,000. At this point, we can just do a sum on the above. And it should give us negative 53,200. Now we want to take the non-controlling interest percentage of that, so that's just going to be 0.1. Oh, let's change that to a percentage. And let's do that. Oops. Let's try that again. That times that. Much better. Remember that that will be a debit because it gets flipped around at this point. And just to show you that. Next, we are going to go on to the balance sheet side of things. So the balance sheet for the non-controlling interest, we want to start off with the common stock and retained earnings of the sub. So let's plunk these numbers in, 150 and also the 139. That will give us our total net assets. Our unamortized acquisition differential is found above, and I know it's shaded blue, but that shows 17,600. So let's include that there. Our profit in our ending inventory needs to be captured, and it will be the same figure that we used above, that 12,000. However, now it's going to be a deduction. At this point, that gives us our SANA, so our subs adjusted net assets. So we'll want to do that plus that one and that last one. We want to be taking 10% of it, and I'm just going to change that once again as to a percentage. And that would be our balance sheet non-controlling interest will be the 294,600 times 10%. That will be credit. And we'll just change that to the blue so you see where it goes. Now we're ready to work on our consolidated net income. So that would be step 5. We first need to start off with the parent's net income. And the parent's net income is stated right here, 36 and 80. So let's 3680. We want to take away our dividends, which we calculated above. And I'll show you right up here in step 3. So let's bring that back down. Oops, and I forgot to make that a negative. There we are. Our profit in beginning. Now this is when we can grab these downstream transactions, remember, as they pertain to the parent. So let's start off with the beginning. It will be negative 7380. And then, of course, the ending inventory will be the 9840. They're coming from right here. At this point, we can do a subtotal of our parent's adjusted net income. And it gives us 15,620. Now at this point we want to maybe offset, or depending on how you want to make the calculation flow, our subs adjusted net income. So you can see from here the subs adjusted net income, if we scroll up a little, is 53,200. We want to take 90% of that. So let's just write actually our 53, we'll just do this, 53,200. We will want to be taking 90% of it. And from there, what it will be is the 53,200 times our 90 plus that 15,620. So overall, you should come out to 63,500. Next, we are ready for step 6. This is exciting times. Now remember, in the event that the company was reporting under the equity method, we wouldn't be doing part of the steps for 3, 5, and 6. So these ones wouldn't even be done if we were reporting under equity. As we were reporting under cost, it's a little bit more comprehensive. So let's start off with our parent's opening retained earnings. We have this figure right here. So let's write it down. Next, we want to include the fact that land is sort of being deferred. So let's include it. We also have our profit in our beginning of 7380. And this will give us now an adjusted figure if we do the sum of these three. After that, we have our subs opening retained earnings, and that is provided right here at 96,000. Let's carry that forward. It tells us what we had as a, sort of like a beginning retained earnings balance when we acquired the company, 56, so we want to add that in there. You'll notice the difference, or I guess the increase between the two, so we want to sort of highlight that. We can eyeball it and we'll notice it's 40,000. And I'll make it negative just to be consistent. We want to now go back on up and say, hey, wait a second, what happened with that copyright? Well, here it is, the 22,000. That needs to get captured as our past acquisition differential amortization. Sort of what's been incurred to date, excluding the current year. That is 22,000. Next will be the profit in beginning inventory. So let's scroll on up to right here. Remember, this is also pertaining to the red. That's where it's sometimes helpful. Did we grab all the red transactions? And of course, now we have another subtotal of these three transactions. At this point, you should be at 11,400. Of course, the parent's percentage is 90. And from that, now we can calculate the consolidated opening retained earnings. I might just actually do a note right here, because this should be that times that. Might be a bit to the side, but that's okay. So the figures we want to grab for this is we want to hop on up to our POR, the adjusted one, and we want to add our subs portion. So our consolidated opening retained earnings will be 93,740. Now we are ready to figure out some of our consolidated line items. So let's start with our consolidated sales. For this, we need a little bit more information on this side of things. So sales, we can see from the left-hand side of the screen, it will be the 340 plus the 820. Now we also need to include one more line item, and that will be the intercompany transactions that we calculated up here. We need to factor that in. So in this case, it will be a negative $382. Next will be the consolidated COGS. So once again, this information is provided right in here. It'll be a combination of the 201 and the 615 less that 382 again. Now this is where it can get a little bit messy. We need to go up here and capture some of these transactions. Now we want to capture them in the before tax category, and I'll just walk through. So for the beginning upstream, we'll need to deduct it. For the ending upstream, we'll need to add it. Then for the beginning downstream, deduct it. And for the ending downstream, add it. So now that we have all that information, I will just manually type it in. So it was 11,000. And then we also had the 20,000, less the 12,3, and adding the 16,4. At this point, our consolidated COGS looks like it's going to be 447,100. Next is our consolidated tax expense. Our tax expense originally is stated right here, but of course we have those transactions above that need to be captured. So, and the 42.8. So let's head back on up here. We are actually going to be doing sort of the opposite now. You can see these are going to be debited and these are credited. So it's sort of the opposite from what we saw here where we're crediting and debiting, but let's just do this. I'll link it directly from here. Minus that plus that one and minus that one. And one last line item, our consolidated inventory. So some of the figures are right here, the 80 and 62. So let's copy those ones over. We also have to include the ones of the parent that are ending. Now, I don't know if you can see it too well, but here it says credit inventory. Remember, it's the ending one. So both of the ending ones we want to capture. So we want to credit the inventory, which I'll just change that around, will be the -20. And also credit the inventory here of -16.4. At this point now we have a few of the consolidated line items and we are essentially done the question because we weren't asked to do a full consolidation of the books, just these particular ones. So this wraps up question, or I guess example 3 from chapter 6. This is part 2 of 2.